This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome to the Luxembourg Intelligence News Briefing Weekly. Today, we're taking a deep dive into how Luxembourg is really strategically reshaping its legal, regulatory, and financial world. We're looking at three big forces: EU harmonization like DORA and AIFMD II, then Luxembourg's own digital finance strategy, think blockchain 5, and finally, the CSSF keeping a closer watch. It's quite a mix.
It really is. And what's fascinating is how these aren't just separate trends. They're weaving together, creating a totally new operational reality for financial players here. Look at the blockchain 4V law for digital securities coming online practically alongside DORA, the Digital Operational Resilience Act, which sets the security standards for the platforms those assets use. Combine that with things like LTIF 2.0 opening up long-term investments. Well, you can see Luxembourg carefully building this regulated space for tokenized alternative funds. But it means compliance gets more interconnected, definitely.
Yeah.
And you need people with hybrid skills, legal, finance, and tech understanding.
Okay, let's unpack that a bit, starting with investment funds and securitization. Seems like a very busy year on the regulatory front. First, there's AIFMD II. It entered into force back in April 24, but the real deadline for countries to adopt it is April 16th, 2026.
All right, and it brings in quite a lot, especially for funds that originate loans. We're talking a harmonized framework, things like a 5% risk retention rule, leverage limits, quite specific ones, 175% NAV for open-ended funds, 300% for closed-ended.
And crucially, this affects liquidity, right? All open-ended AIFs have to pick at least two liquidity management tools, LMTs, from an EU list.
Exactly. LOTs, things like redemption gates, where you can temporarily stop withdrawals or notice periods, making investors give warning. ESMA, the European Securities and Markets Authority, is working on the technical standards for those now, due April next year.
And the CSSF is stepping up oversight, too, with this new circular 25/894.
Yes, that's effective. June 26th, 2025, it's a significant expansion. Basically, any Luxembourg investment fund manager, an IFM, now has to tell the CSSF via their e-desk before they even notify another EU country they want to use their passport to manage a fund authorized elsewhere. So even for an EU UCITS or AIF managed from Lux but authorized, say, in Ireland, the CSSF wants prior notice. It gives them a much fuller picture.
Interesting. So tighter controls, but also new avenues opening up, like LTIF 2.0.
Precisely. LTIF 2.0 European Long-Term Investment Funds has been applicable since January 10th this year. The final technical standards came out last October. It broadens what assets are eligible. The market cap threshold for companies is up to 1.5 billion euros now. It also lowers the minimum investment needed in those long-term assets to 55% of the fund's value and offers more flexibility for professional investors. The big idea is making these traditionally illiquid long-term assets more accessible, even potentially to retail clients.
So what's the takeaway for fund managers and their advisors?
Well, it means fundamentally rethinking fund products and how they're governed. There's definitely increased complexity, more operational work, and inevitably, cost. This is where legal professionals become absolutely central. You're looking at extensive changes to documents, prospectuses, articles of association, and making strategic calls on which LMTs to use. That needs careful legal consideration.
It sounds like it impacts negotiations, too, between managers, investors, service providers.
Absolutely. Pricing, responsibilities, it all needs revisiting. Having sharp legal counsel isn't just about staying compliant. It's a real strategic advantage in navigating this new landscape and upholding that integrity Luxembourg is known for.
Okay, let's pivot to corporate M&A and governance. The EU Mobility Directive that's now fully transposed in Luxembourg, right?
Yes. The corporate bits by February 17th, 25, and employment aspects from April 1st, 25. It really strengthens employee rights in cross-border deals, mergers, divisions, conversions. Companies need to give employees a detailed report 6 weeks before the shareholder meeting, and there's a 4-year safeguard for their participation rights. It adds a layer to M&A planning.
And then there's the blockchain 4V law, which you mentioned earlier, effective since the end of 24.
Right. This is a big step for digital finance here. It smooths the path for using distributed ledger technology, DLT, for dematerialized securities. It also creates this new role, the control agent, specifically for managing securities accounts on-chain.
And Luxembourg put its money where its mouth is, issuing those digital treasury certificates.
Exactly, 50 million euros worth back on June 18th, 25. A real proof of concept, showing the tech works within the legal framework.
Meanwhile, the CSSF keeps the pressure on director duties. That fine for SMG Hospitality SE.
20,000 euros, yes, for failing to publish its annual report on time. It's a reminder that basic governance matters, and the regulator will act.
And there was that Court of Appeal ruling on non-destino in idem.
Yes, quite important. Ruling from February 26, 25. Essentially, if the CSSF has already imposed a final administrative sanction for certain AML-CFT facts, you generally can't face separate criminal proceedings for those same facts. It clarifies the boundaries.
So for M&A deals now, the due diligence list gets longer.
Definitely. You now need to check mobility directive compliance, run DORA health checks on the target's IT systems and cybersecurity, and if they hold DLT assets, review the smart contracts, the control agent setup. This flows into share purchase agreements. Expect new warranties related to DORA, and it impacts directors and officers or D&O insurance too. It all adds complexity, potentially affects valuations, and really underscores the need for expert legal input right from the start.
Let's talk regulatory and compliance. AML-CFT remains front and center.
It does. Luxembourg finalized its updated national risk assessment, the NRA 2025, back in May. It points to risks coming from abroad, flags legal and accounting professions as high vulnerability, and highlights trusts and fiduciary structures as highest risk legal arrangements.
And we have the new European Anti-Money Laundering Authority, AMLA, setting up in Frankfurt.
Yes, aiming for Q1 25. AMLA will directly supervise some high-risk cross-border financial institutions. Plus, the FATF Financial Action Task Force just updated its guidance on virtual assets and VASPs, virtual asset service providers, on June 26th. The international standards keep evolving.
And then there's DORA, the Digital Operational Resilience Act, directly applicable since January 17th, 25.
DORA is huge. It's a comprehensive rule book for tech risk across the financial sector. Think 5 pillars: ICT risk management, incident reporting, resilience testing, third-party risk, and information sharing. The CSSF is the authority here. They've set up their e-desk for incident reporting, and firms already had to submit registers of their critical ICT third-party providers by April 15th, 25.
So the big message here is integration, no more silos.
Absolutely. You can't treat cyber risk and AML risks separately anymore. A cyber attack could easily be used for money laundering, for example. So internal policies, AML, CFT, ICT risk, incident response, third-party management, they all need a major overhaul, a very high effort, realistically.
Which means higher compliance budgets.
Almost certainly. And potentially adjustments to client fees. Plus, expect some complex negotiations with ICT service providers about meeting DORA standards. Again, solid legal frameworks and advice are key.
Okay, quick look at banking and finance. Instant payments are now mandated.
Yes. Luxembourg implemented the EU regulation effective April 11th, 25. Payment service providers, BSPs, have to offer Euro instant payments 24/7 within 10 seconds, and crucially, at no extra cost compared to standard transfers.
And that includes other checks.
Right. Mandatory free payee verification to help prevent fraud and enhanced sanction screening. Banks need to check sanctions lists at least daily and immediately if there's an update.
So legacy banking systems need a serious upgrade.
Fundamentally, you need real-time systems, real-time screening APIs. It's a major infrastructure investment, and banks have to absorb the cost since they can't charge extra for the basic instant payment service. It really pushes banks towards tech investment for compliance and future services.
And briefly, the macro picture.
The IMF sees a slow recovery for Luxembourg, maybe 1.6% growth for 25. The financial sector looks resilient, but they're watching corporate and real estate risks. The Banque Centrale du Luxembourg's balance sheet was substantial, around 984.27 billion euros at the end of April 25.
Finally, let's touch on key tax updates for financial pros.
Okay, the 2025 reforms brought a few changes. The main corporate income tax, CIT, rate dropped slightly from 17 to 16%. So the aggregate rate in Luxembourg City is now 23.87%, down from 24.94%. Also, the minimum net wealth tax, NWT, is gone, replaced by a progressive scale based on balance sheet size, ranging from 535 euros up to 4,815 euros. And there's good news for actively managed UCITS ETFs. They get the subscription tax exemption now, too.
Any other tweaks? SPFs? Buybacks?
Yes, for the Société de Gestion de Patrimoine Familial, the SPF regime. The minimum annual subscription tax went up from 100 euros to 1,000 euros, and they now must legally have SBF, or the full name, in their corporate title. And share buybacks got formalized. Under strict conditions, distinct share classes, full cancellation within 6 months, fair market value, they can be treated as a partial liquidation, which means they're exempt from profit distribution withholding tax. Taking together all these changes across funds, corporate law, DLT, regulation, tax, they really show Luxembourg being proactive, maintaining that sophisticated environment that makes it a top-tier jurisdiction. It's constantly refining its framework.
It certainly seems that way. A lot to digest, but hopefully this deep dive has helped you make sense of these key shifts happening right now in Luxembourg's financial sector. It really highlights the Grand Duchy's commitment to being both innovative and stable. Definitely hit the subscribe and like buttons if you found this useful. This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Luxembourg Intelligence News Briefing.